All right, Managerial Accounting Example 5B. We're going to continue our example of Hutchinson Cookie Company. So notice what we've done here. So far what we've done is we've calculated our original budget, we've determined our actual results, and then we've prepared this flexible budget, which is again a budget at the actual level of output. So what should revenue and expenses have been with our level of output? And then we've calculated the variances between the master budget and the flex budget. So this is what should have happened just as a result of selling more units. And then we looked at our revenue and spending variances, or our flexible budget variance, which tells us how different our actual results were than they should have been given the 43,000 units that we sold. And we've got a couple of variances in here all of our variances need to be explained. Some of them might be small enough we don't particularly worry about, but sort of theoretically we need to be able to explain what happened to these variances. And here's where these hidden columns that I hid from a few examples ago come into play. So what I'm going to do is I'm going to unhide these columns and bring them back into play. And I'm also going to hide the few that aren't terribly relevant to what we're doing right now. So if you think about a few videos ago when we came up with our budget, what we came up with was the dollars per unit for each of our units, or for each cookie that we're making, for each of the inputs that we're using. And so what we did to figure out the direct material cost per cookie is we had to figure out how many dollars per pound we're going to pay for our input and how many pounds we use. We also need to figure out how many dollars per direct labor hour we're going to pay and how many direct labor hours we use. If we think about these revenue and spending variances, let's just take direct labor for example. This direct labor variance of $43,000 can really be seen as happening for one of two reasons. Why did we spend $43,000 more to make 43,000 cookies than we should have? The two possible answers to this question. Either we paid more than $12 per labor hour, so that made our labor cost too high, or we used more than 0.25 hours, we used more than 15 minutes per cookie. Either one of those, or both, must be true in order for us to have used more labor costs than we should have to make the same number of units. Similarly, our $21,000 less than we expected to spend on material cost, ultimately we can see every reason as one of two things. We can see it as either we paid less per pound of dough than we expected to, or we used fewer pounds of dough per cookie than we expected. Now, both of those things could also be true. Maybe we used a little bit less, there was less waste, maybe we also found better price than $5. It could also be the case that these things are offsetting each other and one of them is larger than the other. For example, we could have bought our dough for substantially less than $5 a pound and used a little bit more than 1 pound per cookie, and we'd still have ended up saving money overall. Similarly for labor, we could have maybe paid a little bit less than $12 per hour and used a whole lot more than 15 minutes per cookie, and that would cause our labor cost to be higher. So either one of these inputs, or either one of these elements of the input, either the price per unit of the input or the number of inputs used per output per cookie, either one of those could be different from what our standards or our budgets expect them to be. And so what we do in chapter 11 of the Noreen text is we take these revenue and spending variances, or flex budget variances, we take these and we split them apart into a price variance that's based on the price per our inputs. Did we spend more or less for our inputs than we should have? And also a quantity variance. Did we use more or less of the input than we should have? Now, why do we split these things up? Well, partly it's because we have the data and it helps us understand what's going on. But there's a deeper reason than just, well, because we can. Often it's the case that different people are in charge of these things. For example, if we think about direct materials, often there's somebody like a purchasing or a sourcing manager whose job is to get a good price on the direct materials. And that person is different from the production manager whose job it is to use those direct materials efficiently. Similarly, for labor cost, often you've got an HR department that's involved in hiring and training and determining wage rates and determining which employees get promoted when, or at least having an impact on that. So the HR department, the human resources people, often have a pretty big impact on people's hourly wages. The hours per unit, again, is going to depend on how efficiently those people are used in production. So somebody like a production or a plant manager might be in charge of that. Now, I completely agree. Some of you are probably objecting, well, the HR department gets its cues about who's needed and who should get promoted from the production manager. So these lines of distinction are not completely separated. I completely agree with that. Nothing that I'm doing here is to try to be unrealistic and say that only one person affects the price per input and only another person affects the quantity. However, I think we can make a case that different parties frequently have most, even if not all, most of the influence over one thing versus another. Particularly in the case of a decentralized organization where you've got a purchasing department and you've got a production department. It can be the case that one party has an outsized influence on one of these and another party has an outsized influence on the other. And there are certainly organizations that would do a shared variance where two different parties could sort of each have 50% responsibility for a variance, or one party could take 25% and the other could take 75%. But the price and the quantity frequently have different people in charge of them. The other reason we want to separate these things is often, particularly with materials purchases, often we know a price variance long before we would know the variance on the quantity. So what would that be from? If you remember from our budgeting chapter, we often buy stuff in one time period and we use it in a different time period. So we may buy the materials this month and we might not use them till next month or even next year, depending on if the materials are perishable and how many different products they're used in and that kind of thing. We want to evaluate the purchasing manager as soon as possible after the purchasing decision has been made. We don't want to wait until those materials get used in production and figure out how efficiently they're used to evaluate the purchasing function on the price that it got. We also might not be able to tell exactly when those materials are used. I had a client that made plastic bottles, and they would buy their raw material plastic pellets in huge hoppers, and those raw materials would be used in all the different bottles of a particular kind of plastic. And because the product is kind of a commodity and it's not perishable and we don't really need to worry about batches for quality control quite as much as we do for like pharmaceuticals, they wouldn't really be able to say when the material being used in a particular plastic bottle was purchased. So we can't really, in that case, and that's, I don't think, a unique situation, we can't always tie the purchase and the use together, so we can't really tie the price variance that we calculate for purchasing it at above or below standard cost. We can't tie that to when it's used. So for those reasons, we're going to separate the price and the quantity variance and keep those separated from each other. And that's what our next video will do.